Thank you for joining us. My name is Peter Kashnik. I'm a portfolio manager on Lazard's Equity Advantage team. In this presentation, I'm going to discuss the current market environment, what we see as the chief headwinds faced by many active strategies, and answer the question on many investors' minds. Is there still a role for broadly diversified equity portfolios that make active investment decisions that are driven by bottom-up company fundamentals? As we all remember, earlier this year, the COVID-19 pandemic and subsequent economic shutdown pushed global equities into freefall in February and March of 2020. The rebound, which is still ongoing, has been even more remarkable, specifically since achieving a bottom on the 23rd of March 2020, the MSCI World Index has climbed 48% through the end of November. However, the realization of these gains has been extraordinarily narrow, and as a result, many diversified active portfolios have lagged the broader market despite many delivering strong absolute returns. Additionally, diversified strategies did not, generally speaking, provide the expected cushion to equities during the pandemic-related losses during the first quarter. This frustrating relative shortfall has been the result of three primary factors. First, extreme concentration of market leadership at the stock level. Second, the continuing slump in valuation measures. And lastly, the growing impact of macro factors on market returns. Diversification has proven through the years to be a somewhat defensive and very reliable risk management tool within a portfolio construction framework. This tactic has been driven by the belief that concentration of risk exposures poses perhaps the most significant threat to investor capital based on the inevitability of mean reversion within equity markets. This has been evident in many of the large drawdowns over the decades, from the oil shock in the early 1970s to the end of the technology bubble in the early 2000s to the global financial crisis that followed the Lehman bankruptcy in 2008 and 2009. Broadening exposures has proven to be a reliable and effective way to mitigate risk and minimize the impact of secular events on portfolio returns. However, the COVID-19 crisis of 2020 has tried the patience of even the most stalwart proponents of diversification, as the vast majority of market gains have been concentrated in a small number of stocks. Through the end of November 2020, the top 30 stocks in the MSCI World Index have delivered an average return of more than 83%, about 7.5 times greater than the overall index return year to date. These same 30 stocks have contributed 11.3% of the MSCI World's return for the first 11 months of the year. What this means is that shockingly, index returns would have actually been negative over the same period without these 30 stocks. Simply put, we're currently in a prolonged right tail event that has benefited only a small slice of the market. We can appreciate that internet and related stocks, the so-called COVID staples, have been among the few beneficiaries of the pandemic thanks to lockdowns that have many people working from home and moving everything from shopping to meetups with friends and family online. However, we remain confident that the recent high flyers will undergo a reversal and subsequent price action experienced many times before, like we saw at the end of the tech bubble in 2000. Another important element of the recent market environment is the performance of value stocks, both this year and over the past decade. Value as a factor has been on a steady downward decline since the end of the 2008-2009 global financial crisis. This year, a unique set of circumstances, including a long bull market, a pandemic-induced recession, and dramatic fiscal and monetary stimulus have only worked to accelerate value's woes. On the flip side, investors have continued to demonstrate preference for very expensive stocks, pushing the growth-value spread to levels exceeding those during the late 1990s tech bubble. In addition to growth, quality and sentiment factors have also held up reasonably well since 2009, and those portfolios that have more exposure to these factors have benefited. The prolonged underperformance of value stocks is not necessarily an issue for diversified portfolios. In fact, at first blush, it seems like exactly the kind of issue diversification is set up to solve. However, the magnitude of value's underperformance has created an environment in which it is also difficult to identify growth stocks or quality stocks for that matter that are reasonably priced. Investors who include value as a targeted exposure have a difficult decision to make, namely, keep the faith that markets will eventually revert to the mean and keep searching for relatively strong companies with attractive valuations, or abandon diversification, throw caution to the wind, and buy growth at any price. What both the underperformance of value stocks and the extreme degree of market concentration point to is a market environment in which the clear-eyed logic of bottom-up financial analysis has been de-emphasized. While company fundamentals remain an important element of equity analysis, too often these important features have been snuffed out by some other attribute hardly related to stock-specific characteristics. In the period preceding the 2008 global financial crisis, more than half of overall stock price returns could be attributed to stock-specific factors. But investor behavior began to change in 2008 in the wake of aggressive central bank intervention that flooded the markets with liquidity. Instead of worrying about stock-specific information, such as corporate profitability and relative stock price valuations, investors began to place more emphasis on top-down macro drivers such as relative GDP growth rates and the strength of the US dollar, to name a few. This trend has only accelerated since the COVID-19 correction, with macro factors now accounting for nearly 75% of stock price returns. Looking ahead, we believe there's reason for optimism and confidence in the utility of broadly diversified equity strategies where stock selection is based on active evaluation of company fundamentals. Firstly, macro predominance is often cyclical, and while this particular cycle has lasted over a decade at this point, we expect its influence will decline. In the 2 decades our team has been managing active equity portfolios, we've seen other markets that resemble the current one, and in each instance, we've witnessed investors revert to a more traditional disposition where pursuit of stock-specific characteristics like relative valuations, growth potential, positive market sentiment, and quality drive behavior. We believe that this will persist despite recent challenges. Second, diversification remains a bedrock principle, and a balanced stock selection approach will, in our view, provide investors with protection from secular changes and meaningful shifts in investor sentiment. Additionally, broadly diversified portfolios from a factor perspective allow consistent and sustained exposures to a variety of return drivers without the need to correctly time market rotation from one factor to the next. This allows for steady portfolio performance throughout cycles without reliance on a specific environment for successful outcomes. And finally, innovation will continue to separate the winners from losers. A robust process is still vital to success, and innovation is the lifeblood that allows winning managers to deliver superior stock selection across market cycles.